the New York Stock Exchange. My name is Kiana, Danial. They call me Invest Diva, the go-to trading advisor who helps you make extra money. It's time for this week's Q&A Friday, and today's question is from Adebi. I hope I'm pronouncing her name right. And Adebi writes, Kiana, first I'd like to say what a great job you're doing. I too am a female engineer, aerospace engineer and pilot. You go, Adebi. It's always great to see other women in male-dominated industries with style and brains. You bet. I have a little problem. I have enrolled in your education program and studied all your lessons twice. I usually have winning trades, but for a lot of them, I put a stop loss too close to my entry order. I usually put about 5% on every trade and try to go for that at least 1 to 2 risk-reward ratio. It's so frustrating to be right with your analysis and then being stopped out because the stop loss wasn't 5 or 10 pips longer. Please help. Adebi, this is a very common problem that you're having. I'm so proud of you for calculating your risk-reward ratio carefully and taking a risk-averse approach to trading in all forms, long-term and short-term. Deciding the appropriate time to exit a position is just as important as determining the best time to enter your position. Entering a position is less emotional than exiting, and at the end of the day, it's your exit strategy that determines your total profit. Some traders are tempted to ride the tide a little longer, or in the unthinkable case of the market going against you, your heart tells you to hold tight and wait until your losses reverse. That is why setting a stop loss and limit order prior to entering a position is very important, and I'm glad that you're doing it already based on your risk tolerance. But the markets can sometimes get too volatile temporarily, which can result in a premature automatic exit. To avoid getting kicked out of your trade prematurely, the best way is to follow up with the market sentiment and keep up with the economic news. While I don't suggest changing your profit limit order, you can adjust your stop loss by monitoring how fast the market is moving against you. Only if you're confident with your position and have solid confirmation based on the fundamental and technical analysis and believe the market will eventually change direction to your favor, then you can loosen up your stop loss level. To measure the market sentiment, it's best to switch into anywhere between the 1 minute to hourly charts every once in a while. Another basic technique for establishing an appropriate exit point is the trailing stop method. The trailing stop method simply maintains a stop loss order at a precise percentage below the market price in your long position or above it if you have a short position. The stop loss order is automatically adjusted continually based on the fluctuations in the market price, always maintaining the same percentage below or above the market price. You can then relax and know the exact minimum profit that your position will gain. But before that, you must make sure that you are setting your trailing stop based on precise risk tolerance calculations and not based on emotions. Also keep in mind that this technique requires the patience to wait for the first quarter of a move, which means a number of candles on your trading chart before setting your stops. Thank you, Adebi, for submitting your question, and if you have a burning investing question you need to be answered, hop on Invest Diva community and ask away.